Welcome to another episode of the Straight Up Chicago Investor Podcast. I'm Tom Shellcross. With me, as always, my partner in crime, Mark Ainley. And Mark, we had two Marks here. It was a little confusing.
Yeah, it's funny. You kept every time you say it, and like maybe if I wasn't 100% like, he's talking to me, or like you kept referencing it. I kept getting nervous. I missed something. So, yeah, it's funny whenever you put someone with the same name in the room.
So, and it's been a while. We both took some time off for the holidays. This is our first recording of the new year. So I think we'll air in February, but this is the first time we hit up the mics in 2024.
It is. And by the time this airs, it'll be put out there. But I did the mock interview of Shay Murray yesterday in our new studio. So looking forward to recording some in person with you here this year as well, in addition to what we've done the last 3 years. This has been
crystal clear.
What's that?
We're gonna sound crystal clear.
Oh yeah, well, do it. You're gonna the cameras that you don't realize, but you and I bought. They're 4K, like they're awesome, the quality and all that. So it's gonna be a good image for people actually on online as well too, on YouTube.
See, I'm okay with the blurrier camera. I don't need to show all my facial features to everyone. I'm cool.
My kids said that we have to put 4K in the corner of the screen to brag about it. I'm like, I don't think anyone really cares about that. Like,
yeah, I don't know if the kids know more than we do these days.
Part of me, outside one side of my mouth, I think, you guys should quit busting my chops. The other side is like, yeah, they might have something. So,
I kind of felt like the old man today. We're talking technology.
Yeah, well, it's technology in our space. It's funny. I was going to say this during the show, but like how archaic this industry still is on so many different fronts. I made reference to us trying to pull comps for the properties we have under management. It's pretty manual for some of the different things when we underwrite, when you look at these spreadsheets, and, we reference in the show passing memorandums back and forth when they could be simply summarized versus looking through these 18, 20 page type documents, which a lot of them is just sexy pictures more than actual words or data. So it's which sometimes I think, if the solution of summarizing these memorandums versus looking through them, I think you might have a more more analytical view at what is on that PDF versus getting the blue car syndrome of seeing the good looking pictures or the nicely groomed property or the happy tenants in the courtyard, like whatever it might be. So
yeah, the happy tenants in the courtyard, all from a different ethnical background.
I know.
You got to hit every.
Yep.
So, but no, this is a good one. This was one, we have a Chicago native here who's doing well nationally. Thank you to Sabrina Wiring for getting another great guest on the show. So yeah, let's go. Let's get the Chicago. I'm sorry, not the Chicago facts. See, I told you it's been a while. Let's get our housing buyer tip of the week knocked out, and let's get our intro going.
All right, so 2024, we have these new laws that came in place. We've talked a little bit about them, but one that surprised me that I didn't realize till a couple of days into New Year is the Illinois Security Deposit Act updated one of their requirements or restrictions. So we talk about Cook County, we talk about Chicago a lot, and the rules you have to file 30 days, 45 different timelines, and what you have to document. The Illinois Security Deposit Law, which they've changed requirement of who that applies to, and they also changed the restrictions and timeframes to pretty much match what the city and Cook County does. But now, if you don't do those things, there could be penalties up to 2 times that amount plus attorney fees. So it's something that, it's far from, there's not too many attorneys are taking outside of Cook County landlords to court, but it's something to make sure that you're starting to follow the rules for when those things do start coming up, you're at least within those guidelines. And we'll link to the show on the new guidelines for this new Illinois Security Deposit Law.
All right. Today's guest. All right. So he has been a developer himself. Since then, he got involved in the tech side of real estate, sold a very successful technology company, and now has HelloData, which is something we're going to talk about. Great product that surveys data. Man, what we learned today, it's not just scraping, data points and ones and zeros, but it's taking, it's leveraging photos, it's leveraging AI, it's isolating variables, just a ton of good stuff. Mark, probably more importantly than anything, U of I grad with 4 kids.
Yeah,
so, right up my alley here. But without further ado, let's go ahead and get started with Marc Rutzen. Mark, welcome to the show.
Thanks for having me on.
Yeah, so shout out to Sabrina for bringing us another fantastic guest here. We have a lot to talk about, and you've done a lot in the tech space, around the real estate industry. But before that, you had a lot of early development projects. Like you were quote unquote one of us. So can you just talk to us how you got started in some of those early development projects?
Yeah, so my background, I started in school in architecture, then moved over to real estate development. Graduated in 2011, which was just a phenomenal time for real estate development. Tons going on in 2011. No, it was pretty dry market, right? So I started going for neighborhood stabilization program deals. I actually networked with all the different developers in the NSP program in Chicago and tried to find a job there, and ended up landing with a company called Three Corners, where I did master plan community development in Moline. I did a federally qualified health center, and I did I think it was 4 neighborhood stabilization program deals where helped in various ways with getting the deal set up, managing it through construction, and then ultimately getting it leased up.
Before going further, give the audience what NSP was, because I don't think a lot of people know what that is.
Yeah. So in the heights of the Great Recession, the government pumped a lot of money into the economy to help stabilize all these foreclosure properties. And it was, I mean, you guys know it was pretty bad in the single family home space, but it was also bad in multifamily. And a lot of these properties went into foreclosure. The part of the program I was working with, we would buy multifamily deals, put money into them from these subsidies, renovate them to a high level of quality, and then get them leased up to kind of stabilize the neighborhood.
The I don't know your experience with on some of the private development side of things, but it was crazy. Like the amount of money that I mean, we did 2 4 flats in South Chicago, and I think all in we had it was like 600 $700,000 into these 4 flats that you're buying on the market right there for 20 grand. This was crazy.
It was crazy. And, our group did the construction side of it too. So it was like we made money on the GC side and made money on the investment side.
I got the whole whirlwind of prevailing wages and what that really means, and how you document all that. Gosh, that was talk about horrible experiences with Chicago Title and prevailing wages.
Yeah,
Where's this money coming from? Is it federal? Was it the city?
it's federal, and they gave it to the states and the cities. I don't know exactly the mechanisms, but I know that the city of Chicago had quite a bit to deploy.
Eight
And,
hundred million it was.
yeah,
It was a crazy number.
pretty huge amount. I mean, it was
I don't know
nice.
where the hell that went, but 800 million is a lot of money. You'd think would you'd be able to see it somewhere.
Yeah. All right. So where do we go from there? Right. We have some success with these developments. And are you saying, hey, I'm going to keep on doing this, or walk us through here?
Yeah, so from there was great experience, and then moved into an owner's rep role for a bit, then went into market analysis with a group called SB Friedman. And I got to see the industry from a few different angles. So I was doing the development and doing analysis there. I was seeing the owner rep side for a period, and then I was doing the market analysis. And no matter how I approached it, it was a lot of work to prove out market rents. It was a lot of manual effort. You're going to property websites, you're going to listing sites, you're going to the rentometers of the world, cobbling together data, and then making subjective judgments on it to see, okay, I think this is the most comparable. I think this is the best floor plan comp. Okay, I'm gonna say market rents are here. If you're wrong, well, there's some significant risk, especially in development and value add deals. And it just, to me, it seemed crazy that with, the iPhone was really prevalent and tech was booming in different industries. I was looking at real estate like, how do we operate this way? I can't believe it's so manual. I always loved tech. I wasn't in it, but I always loved it. And I figured there has to be some way to make this more efficient. So I started doing, I launched a company, MAR development group, where I was actually building technology for real estate people. I had a overseas development team. I did the mock-ups and the design and kind of laid out the scope, and then they would build it. And I actually got a bunch of deals that way, started to kind of cut my teeth on the tech side. Ultimately, I was trying to pitch Kaiser Group, Lee Kaiser, who's prolific in Chicago real estate, was trying to pitch him on a mobile app for Kaiser Group, because I saw they launched KIG in 2015. I'm like, hey, KIG, your tech-centered brokerage, you guys, you could use a mobile app, right? I do stuff specifically tech for real estate. And so Lee, being an amazing broker, he actually reverse sold me to join KIG and be their data analytics officer. It was like a day, right? So I talked with him that day. Then he's like, talk with my partner. And then like a day later, I got an offer. I'm like, yeah, I'm gonna do this. This is amazing. Tech-driven brokerage. That's exactly what I want to get into. And from there, I actually got into some programming and data science myself. Really try to learn it as much as possible. I'm an avid reader, so I was just reading as much as I possibly could, how-tos, programming books, whatever I could. And ultimately, that work that I was doing at KIG led to my first startup, Enodo.
That's awesome. Lee is awesome, and he was on episode 68. If anyone wants to go check that out, there's one of the older ones.
All right, so with this, like, I gotta believe there's already programs that are scraping data at this point, though, right? Like, is that what it was at that point in the game? Because what year are we in right now?
Yeah, at this point, it was 2015 when I joined KIG, and then we ended up launching Enodo. So it was me, Susan, and Lee. We launched it in 2016. And the big thing that was really resonating with KIG's customers, we started doing some consulting projects in addition to the brokerage. The thing that was resonating is I built this little application that would basically take all the attributes of a property and say, if you change this attribute, how would your rent change? Right. So it was a pretty simple tool, a little widget. And I showed some clients and like, oh, that's amazing. Like if I increase the square footage, that's what the rent would do. It'd be higher. And I did an analysis of South Shore properties, a collection of South Shore deals, and then Hyde Park deals. And the idea with this analysis was, okay, what would happen if we were to take this same property that's in South Shore and move it to Hyde Park? How would it perform if you just change the market? Like break the property into the sum of its parts and the market into the sum of its parts and see how would performance change if you just picked up the property and moved it to a better neighborhood. So we did that. It really resonated. And that was kind of the premise behind Enodo, which was built to quantify if you do the granite countertops, the hardwood floors, the roof deck, how much more rent can you get? What's going to be your rent lift? And this was during the time like 2016, 17 was the amenity wars with developers. They were like, oh, I'm going to do the dog run, the dog washing station, the infinity pool, whatever you got to do to raise rents. And no one had any real data backing up how much rent you could get from those things. So we provided that data to back up their decisions.
So if you don't mind going a little behind the curtains, like, how do you scrape that? Like, hey, granite countertops or whatever it is, these qualitative items.
Yeah.
Like, how do you find that? Hey, this is going to get you in this neighborhood, another $80 a month or whatever that number is, right? Like, are you mainly going through and looking at pictures like that? I'm assuming that's not it, but like, how do you actually come up with this?
Well, it was back in 2016, tech wasn't as advanced as it is today. And I'll get into how we do it with HelloData today a little bit later here. But at Enodo, yeah, we went to several different listing sites and scraped data every week. We were going back and collecting this data. And we built basically a script that would go through and recognize the key terms. Like if they say has a swimming pool at the property, right? Like we know that, but we also have to be conscious of the fact that they could be saying there's a swimming pool down the street, right? Because we were doing this nationally. So it's not just like Chicago properties, it was like suburban garden style properties too. And so we built and this was something that I had to go through and read like 10,000 listing descriptions. There's some ridiculous number to figure out how to do this. But we basically made conditional logic as our first approach to say, hey, if the term pool occurs, is it preceded by swimming, or is it followed by table, right? Like a pool table, right? That sort of thing. And then are they saying, is it a swimming pool down the street, or are they saying it's actually at the property? Based on the language, we built a model to do that and later converted it to natural language processing. Now, the key thing was building that data pipeline so it was repeatable. It just kept going. It worked like clockwork every week. Then we layered in demographic data, school district ratings, walkability, all the things that you all know are important for real estate. And we built an algorithm that was essentially souped up regression analysis. Everyone learns like regression in stats class, and they quickly forget it unless you're in data science or appraisal or something. You may use it. We started with a regression model, then went to a more complex neural net model, and ultimately moved to something that really worked at scale across the country to isolate each variable.
All right, and then what? And this one gets sold then? Is that the happy ending?
Yeah, that's the crazy thing is like, so we launched October of 2017, and that was kind of our soft launch, and we had some early adopters sign up. We ended up getting the offer to sell the company in September of 2018. Unexpected to us. We were talking about a lead investment from one of our users who we're kind of negotiating a pilot program with Walker and Dunlop, and they did not care so much about the rent premiums and the rent lift you could get, but we could parse rent rolls like really, really accurately. Like, so you upload a rent roll. We built this as part of the functionality of the platform because we figured people want to put their deal that they're looking at alongside market rent data and see, if I do X, Y, and Z, how much can I raise the rents, right? Here they are today in the rent roll. Where can we take them if we do this value add program? So we built a rent roll parser, and it turns out lenders and brokers that work nationally have such huge volume of rent rolls, and it takes sometimes up to an hour to get a rent roll into a usable format in Excel. But we just built a way to do it in a few seconds, and that was very, very valuable to them. So in the call I was having with Walker and Dunlop to discuss potentially investing in our next round, they kind of surprised me by saying, "Hey, why don't we just buy you guys?" And they made a really good offer. I'm like, "Okay, I'm 30 years old. I'll take my first exit. This seems like a very good
Play
idea."
cool on the call. Let me think
Try
about
to
it.
play it cool. I'm like, "Oh my God." It was before like Zoom and video calls though, so it was a little bit easier. I could just be quiet and not say anything.
Wait, so it's a great story and it's a quick turnaround, right? Like you didn't have it for that long. Do you have any of those horror stories, those sleepless nights of trying to get this thing off the ground? Because I know that resonates with
Oh,
our crowd here. Just, we're all entrepreneurs at heart.
oh yeah, there were times where there was a huge period of time where I was just like every morning 3 a.m. I would wake up and I'm like, oh my God, I gotta do something. I couldn't get back to sleep until like 5:30. I'd send emails out. People are like, why is this guy sending emails in the middle of the night? I'm just like thinking about it all the time. And I'm sure you guys feel the same way about real estate. You're thinking, what's the next move? What's the next deal? How am I gonna move things forward all the time? And compound that with approaching the end of your runway. We raised money. We raised a little over 2 million. We built a team of 10. Um, we were running out of runway at some points, and that really weighs on you because it's not just thinking about the upside. It's thinking, whoa, this could all go away if I'm not successful with it.
Man. And then what were, raising $2 million, you made it sound so easy, right? For a lot of our listeners, like, wait, how the hell? Because like it's something that we have to do on deals as well, right? A little bit different scenario. Did you have just the basket from, hey, your time that you're already in this industry? Like where were you turning to?
Well, fortunately, my partners Susan and Lee had plenty of real estate connections that had made their own fortunes in real estate, their large portfolios, and for them, putting in 50 or 100K is not that big of a deal. I do that with any LP would do in a real estate deal. I mean, they kind of looked at it that way. So we were able to get just a bunch of real estate investors to come in rather than go the VC route and have to negotiate like a complex deal structure and they get paid first when we sell, that sort of thing. We just did the simple agreement for future equity, Y Combinator's template, and we got a bunch of real estate guys to invest a little bit each, and that was enough to get us to where we needed to go. Today, with HelloData, we're actually not doing that. We're not building the big team, raising the big round because we don't need to. We kind of learned over the last 8 years how to do things really efficiently, and so we're able to do it with a much smaller team.
All right, so that's awesome background, awesome context for our listeners. Let's talk about HelloData, right? So you have your first exit. Give us the next, what happens next here and leading us into HelloData.
So our team of 10 went over to Walker and Dunlop, and we kind of formed like the application development team. There wasn't much of they had like Salesforce devs and an IT group, but they didn't have like an app development team. And so we formed that team. We really took the tech to the next level. We integrated the rent roll with their existing workflows into their underwriting models. The T12 extraction we took to its logical conclusion. We can basically take any T12 and map it to Fannie, Freddie, HUD chart of accounts in seconds, right? So we really pushed internal efficiency and pushed the platform to where it needed to go. And in doing that, we built internal tech that helped them source billions a year in loan volume. Like these were separate things that we developed afterward, after the acquisition. I rose up through the ranks to chief product officer, scaled the team from 10 to around 40 in total. And so it was data scientists, product owners, customer success were all part of my group. And so I did the kind of corporate thing and I navigated it as best I could. And, we added a lot of efficiency. But after, 4 years doing it, I was kind of like, I like the startup world. It's pretty, it's pretty fun the first time. And I think I've learned a lot. I can probably do it again. So I was kind of thinking about what would be next, right? And the crazy thing is, during that time as chief product officer, I had a lot of startups pitching me, right? They're trying to sell me their data, they're trying to sell me their products, they're trying to say how awesome all their stuff is. Got to be on the other side of the fence. And I saw that the same problem that we were trying to solve with Enodo, I mean, some of the same problems were still there. Like no one really solved some of these things. Like determining market rent is still a process of going to property websites and listing sites and trying to cobble together data. It's a little faster today, but it's still pretty manual. And no one trusts the data sources that they have, right? Like everyone's like, oh, that's a good starting point, but no, I'm going to go check the property website myself. I'm going to verify this. Of course, everyone's going to do that when you're looking at a big deal. You have to do your due diligence, but it shouldn't be that you don't trust the stuff that you're paying for, right? You should start from a place of trust and then build off of that as needed. And so, Tim and Nico, who were my first two hires at Enodo, are now my co-founders in HelloData. They had left and started building some pretty cool tech to analyze images, to extract data from documents. I saw what they were doing, and I'm like, guys, let's do this again. Let's team up. So I joined them in May of last year, and we launched HelloData. And the goal with HelloData is it's pretty straightforward. Use AI to determine your most relevant rent and expense comps, analyze them every day, and then tell you where you should sit in terms of rent and expenses relative to the market, right? We're solving that problem of figuring out where market rent should be, and at the same time benchmarking expenses so you can go soup to nuts and get to NOI in just a few seconds with our platform.
Well, I think that's a big problem even in the property management industry. So we manage 1,500 homes, and this has been a highlight because right now we're doing rent reviews for springtime, and it takes us 15 to 20 minutes each one to do it right, pull the information, make sure we're doing it, and a hell of a lot of time to. In the end, we're lining it up next to if we just put 3% on everything. How far off are we
Yeah.
versus all that time? And yeah, it sounds like you created that solution for almost like a problem we have. So we might have to talk more about that.
Along those lines, who are the potential end clients before we get into the actual product? Like, is this designed for? Investors, appraisers, lenders, it all the above. Like, who's the targets?
It is all of the above, but we specifically went after asset managers and property managers to start because with Enodo, it was more focused on developers and value-add investors. Problem with developers, they're hard to sell to because they're very gut-driven. Like, I'm not going to convince a developer, hey, my analytics are better than your knowledge of the market. They may use it as a supplement, but they're not going to, say, oh, this is really better than I am at picking the winners. So we kind of learned from that, and we're like, this time let's focus on the operators. Let's go to the asset managers who have like a healthy kind of distrust with property managers sometimes. They're like, all right, let me poke holes in that and figure out, are you really using the right comps? Are you making the right assumptions? And the property managers, they're asked to do so much these days. Like they have to be customer success, sales, data science. They're like, hey, tell me what's happening in the market and how it affects my deal and where I should price. Like, okay, the average property manager should not be asked to do all these things, and they're under a huge time crunch. The turnover is crazy in property management. So we figured, okay, go to property managers and asset managers, make that relationship smoother. So they're looking at the same data, understanding it in the same way, and anywhere where you could alleviate friction, you can create value.
Yeah,
Uh,
the traditional property manager has turned into more of an asset manager, which there's a big distinction between the two.
for sure, it's so many hats they're asked to wear, right? So that was the initial premise. We're like, okay, let's price rents. Let's do it in a market-driven way, right? Instead of doing the property management software integrations where revenue management uses the data in your own Yardi, RealPage, et cetera, instance to predict where you should set rents. What if we could do that at the market level? What if we could just analyze rents every single day? If we could determine what is most comparable at the floor plan level, well, and since we're monitoring every day, we could see, hey, this floor plan was removed from the market, so it essentially closed, okay, and it's statistically the most similar to your floor plan that you're trying to price. So that was the premise behind it, right? And so that grew though because we didn't expect acquisitions teams like today, we thought deal volume was down across the board. Everything we read is deal volume's down, but they're looking at a lot more deals before anything pencils, right? The old look at 100, bid on 10, close on one. Today it's more like look at 150, bid on 10 and really cross your fingers to see if they're actually going to go through with it, and then hopefully close on one. So they're looking at a lot more deals, and so we actually have a equal mix of asset management / property management on one side, the operators on one side, and the deal teams on the other. And with the deal teams, there's appraisers, brokers, lenders, all kind of related to the deal, and we've got customers in every one of those segments.
What about the market as far as teaming up or being add-on service to various property management? You mentioned Yardi, you mentioned RealPage. Like, are they building their own products within that stuff, or is this something that they're working with developers like you to kind of add on to what they already have?
Oh, they have their own products and their own teams, right? I mean, they offer tech, but a lot of times it's out of reach in terms of costs for a lot of investors, especially like the mid-sized groups. Right. If you get to the national players, of course, they have deep pockets. They can be like, oh, I want Yardi, but I also want RealPage, but I also want CoStar, and I'll try that too. Right. You could get all of it. But like the average investor, okay, no, you're not going to spend for all of that. And some of the price points of these products that help you price your units, it's just a lot of money. It's like $4 per unit per month. You can imagine that is penalizing your growth as you get bigger. It costs more and more. So we just made it a flat 250 per user per month, and you can run as many deals as you want, and you'll get pricing recommendations. You'll be able to analyze acquisition deals. You'll get the expense benchmarks. It's all kind of in one platform. And we found that price point and that package of features, it's kind of crossing functionality between a few different things, because the asset managers look at revenue management systems one way, but really the deal team should have access to that data when they're analyzing. And so we just combine different functions into one platform, and it's really helping all these different groups kind of look at it in a cohesive way, backed by data science and with transparent explanations for the why behind each recommendation.
So let me ask just a real, probably borderline insulting question. Like, you're an investor, like, okay, why can't I'm not going to pay for CoStar. I can just use Rent-A-Meter for 10, like something insanely cheap. Can you, very elementary question, but like, what's the difference? Like, what else are you providing besides just the data that they're scraping to what you guys are doing? Like, Just so you can level set that this is not apples to apples.
So everyone does a radial analysis, right? 135 mile. What's in that radius? Well, okay, there's good properties that are great comps. There are ones that are bad comps. There are ones that are not comps at all. By no stretch of the imagination can they be considered comps. When you take a radius and you just average that, even if you get a little bit more sophisticated, you're saying, okay, like Rentometer does, you can put in your beds, baths. I don't think they do square footage. I'm not sure on that. But even so, there could be a 3-bed, 2-bath unit in a 500 unit high-rise building, and there could be a 3-bed, 2-bath unit in a 4-story walk-up. They are not comps. They're not at all the same. So what we do is we use this computer vision model we built called Quality Score to comb through all the listing photos in real time as we're collecting the data every day. Analyzes the condition, quality, and attributes of each listing photo. So we're scoring the kitchens, bathrooms, common areas, fitness centers, everything. And
So you're scraping photos as well then.
That's
well,
great.
we don't store the photos because we don't want any copyright issues.
Yeah.
But we do analyze them.
Disclaimer accepted. We're good.
No, we analyze them on the fly to store that data. So we're basically scoring on a 1 to 10 scale each property overall in terms of its condition and quality. That plus we extract over 200 different amenities and attributes from the listing text and the photos. We kind of cross compare the attributes we detect from the photos and the listing data. And we synthesize the data for the market up to the property level. So we're comparing the very micro sub-market around each property in terms of the people, the educational attainments, the school district ratings, the crime, the walkability, all of that synthesized up to the property level. So we're getting a comprehensive view of the condition and quality of the properties, all of their attributes, and the attributes of the market immediately surrounding them. That gives us the best comps, right? Because all this stuff, you all know you can do in Excel manually, subjectively, and get like an okay result, but that is more sophisticated than what you get from like a Rentometer, right? They're taking a radius, they're saying, hey, here's the average of 3-bed, 2-bath units. We're saying this specific floor plan in this specific deal is the most statistically comparable, and it closed just 7 days ago at this price point. And now, added to that is AI has advanced quite a bit since we did Enodo. We could not do this before, but now we analyze the specials that are posted to the property websites, and we actually pick up the amount of the concession that's being offered on the day the unit closed. So say that unit closed 7 days ago, that 3-bed, 2-bath, there was a 1-month free rent concession posted on the property website. We do the effective rent calculation to show you, hey, the real market rent is here based on this unit that is very similar that just closed. It's essentially doing what an appraiser does at the building level, but taking it down to the individual unit level and pricing every unit in a building that way.
That's a lot. And then I guess how often are you running this then, right? Like, is this daily, weekly?
Every day.
So every day you're going through, if I'm an investor in Chicago, you're going through every single listing out there through all these different sources and updating, your data based on the pictures, the price drops, etc.
Yep. That's where people like it's the granularity, right? So yeah, you could get a market average, say like, hey, my rent should be roughly here. But reality is your specific unit you're trying to price may be above market. And so you lost that delta, right? You're more competitive than what has closed recently. And we could prove that out statistically. You have a better product, so you should be able to get higher rents. Or you don't have as good of a product, and you should not try to push for that higher price because, well, you're going to stay on the market for a lot longer. Because we're tracking every day, we can see how long each unit stays on the market, where it closes, right? And we can even catch the stuff that, maybe was posted on a Monday and then leaves the market, it's taken down on Thursday because it was properly priced, it moved fast. Go to the property website weekly, you're going to miss it. If you go just for a specific deal, you're going to miss it because you might not have seen that specific unit at the time it was listed. We catch everything so you can see, oh, that floor plan is exactly what I need to compare to. and it closed before I had the chance to see it on the property website, I can go to HelloData and see exactly where it closed, the concession that was in place, the square footage, the beds, baths, the attributes of that property in that specific unit to inform my pricing strategy.
And when you say attributes, are we talking, hey, it has in-unit laundry or laundry in the basement, stainless steel or not,
Yep.
stone, quartz, I guess take us like how granular is all the quote unquote extras?
We track over 200 different amenities at the building and unit level. So yes, it's things like that. It's things like which utilities are included or excluded, right? That's really important. It's the policies at the property. So do they accept short-term leases, things like that? Like all of that does factor into comparability. I'll say the main stuff comes from year built, number of units, in the photos, right? That's where we get the bulk of it in the market, of course. That's where we get the bulk of it, but all that other stuff is kind of like the fine-tune level to really get you to what's most comparable. We even built early on, we don't use this in the comps algorithm right now, but we built, and we're probably going to incorporate it soon, algorithm to extract from the floor plans, like the image of the floor plan, the rooms and dimensions. So in the future, we'll probably use this to inform like development, which floor plans are performing the best and what are their attributes? What are the dimensions and room types present? Like, I think that's a super interesting analysis and something we want to add in later. We have the algorithm. It's just you haven't added it into the main comps algorithm yet.
That's a lot, man. Like that is a lot of information.
I know I tend to get excited about it, talk a lot here. So I can summarize it by saying we look at your rent comps and your expense comps every day, figure out which ones are most comparable, and then use that to tell you where to price and where your expenses should be.
Got it. And if I'm doing, development or a value add, am I able to isolate these variables? I think you mentioned that before, say, all right, hey, like, should we do whatever it is, right? Like, should we gut the bathroom? Should we do stone in the kitchen? Like some of those decisions where it's going to be extra money, are we going to make our money back? Like, does it allow me just to see the yay and nay of making those decisions?
We're starting to get more granular with that. Right now, what we do is we surface your value add comps. So we're looking at stuff that's next level up in terms of finish level and amenities. And we serve those up as comps if you select the value add comps option. So you can kind of see if you do like the chart with your rent relative to your comps, like the typical bar chart. If you do the value add comps, you're going to be at the low end. Everything else is going to be higher. Right, so you can kind of see what rents you can get if you were to be similar in terms of quality and
Yeah, you get the baselines for each of them.
yeah, we're working on ways to do it at the floor plan level and say within this building, these units are getting 30% premium over these because they're the renovated ones and these are the classic ones. That's a little bit more involved, but we're pretty close to a solution there.
Where when I imagine, so you have a city like Chicago, you have the different eras of buildings. You have the big ones are built in the 1880s, the 1920s, the 1950s, 60s, and then you got the newer stuff built in the last 20 years. Everything that, you got single family to condo to flats to apartments, like, and you're able to incorporate that, and all, like with a big city like this, I imagine it works anywhere than if you could do it here, right? Like, is that kind of your thought when you got going?
It's fully national, right? So works in every market. It's kind of crazy because the best way to demo it is to use someone's deal. So otherwise, if I use a sample deal, they're like, I don't know that market, I don't care. If I use their deal, the way I close most of the demos I do is I go to our unit details table and I show a specific unit and I open our little chart that shows how the rents fluctuated from the time it first appeared to when the listing was removed. That last price on the day the listing was removed matches up with what's on their rent roll like 90+% of the time. And so I say, hey, open your rent roll. Let's open this. And then I find the exact number on their rent roll. And then they say, okay, I'm going to purchase this. Because if you got it for my property, you have it for all the other properties. And that's where we shine the most is getting that really, really accurate rent data.
That's awesome. Maybe we have to do a side. We could post that on the Straight Up Chicago Investment Group, just investor group doing. Maybe I'll give you a rent roll, and we could kind of test it out in a 10-minute video or something. So maybe we do that.
That'd be awesome.
So right now, this is, just in the last 5 years, from your first startup to the second startup, like, I imagine you'd agree with me. In 10 years, this will be the norm, right? And like, where's your head going next, man? Where's the innovation? What do you think is going to be drastically different 10 years from now, or a solution for a huge problem that no one can foresee at this point?
Oh, wow. 10 years is kind of hard to look that far
Well,
out.
maybe it's a 5-year question in technology, I guess, or a 3 even.
In terms of things that will have the greatest impact, I do think, if I were looking a decade out, I think self-driving cars will be pretty huge. Because right now, every time I drive to the city, it's like an hour plus endeavor to, to get even to the West Loop. And I'm in Naperville. It's a long drive, right? But that's because people can't drive. If you had AI do it, well, everyone's driving at maximum speed the entire time, merging perfectly, no accidents. Yeah, that would be a huge boon to the economy across the board. I think that's going to be massive. In terms of real estate, I always joke that in the very near term here, like in real estate, what we do, we analyze data, we put together an investment memo, we present that to people. They're like, yeah, I want to put money in that. And then they summarize it to their people and put another memo to them, right? It's summarizing data back and forth forever in PDFs, which I hate. I want everyone out of PDFs. So I feel like with ChatGPT and people being able to put these OMs together faster using ChatGPT. So many people are doing that these days. On the other end, ChatGPT can now read the PDF and summarize it for you. So why are we using PDFs? We're basically just putting the data into a PDF, sending it, and then taking it out of the PDF using the same tech. I think real estate is eventually going to learn, hey, why don't we just skip the PDF and just exchange the data, and that will make everything a heck of a lot easier.
Based on data the internet gave me, about a third of our listeners are people that have not bought yet or own 1 to 2 buildings under 4 units. What advice, maybe something like this is not cost effective for someone like that that's just getting going. What advice would you give them that they might not be already doing when it comes to, rental comps or analyzing deals or anything like that?
Um, I think our software, yeah, at the 250 price point is maybe not good for everyone. We do have a 7-day free trial though, so I mean you could check it out.
Oh, so you just need a bunch of emails then.
Yeah, yeah,
Oh,
Yeah.
that's a great hack. I'm in.
So I mean, I encourage people to check out the 7-day free trial because even if it's not good for you now, like it's too high of a price point, like when you do have that deal, like people routinely pay appraisers and feasibility consultants a lot of money to prove out a deal. Well, do that with data science. Like it's 250. You could cancel at the end of the month. Like say you do get your first deal, and you're like, man, I really want to dig in. 250 to make sure that it pans out the way you want it to is not that much of an expense.
Oh yeah, for sure. That's well, Mark, I was not fishing for that deal, but you're an amazing entrepreneur when you're saying, "Hey man, come do this, man. Take advantage of this." I love that. That's smart. Like even if that person goes on their user 7-day trial and what didn't make sense for continue on, man, that's free. If your product is as awesome as I think it is, then that's free publicity that you're not paying for in marketing.
It's straight out of the Alex Ramosi book
Yeah,
right
yeah,
there,
right.
right?
That's
No,
So
on like the analyzing rents, when you do get down to like four unit or smaller properties, it's less of an issue to get really granular. I mean, our product tends to cater to like 50 plus units for the most part, just because like you misprice units in a 50 plus unit building, you can start to lose a ton of money that way. We're not just talking one unit. It's like you mispriced 10 units in the same floor plan. You're starting to lose a lot of money there.
yeah,
So,
in an A class area where cap rate
oh,
might be 5, right? 50
for
bucks a
sure.
unit. Add that
It,
all up
it,
times 12 divided by 0.05, 0.06. It's 7-figure number there.
it really adds up. And that's why we tend to get the larger operators. But like, yeah, we cover everything down to 2 flats, right? So people could try it out. And I'd say like when you're analyzing like a 2 or 4 flat, you can gravitate more toward market averages and average rents because that's what everyone else is doing at that level too. People will get more granular when they dig into the due diligence process, but it tends to be more subjective because the data is not as good at that level. Like the typical 2 flat operator is not putting in like their year built number of units. Here's updated photos. Here's a complete description of my amenity package, which is really not that big of an amenity package for a 2 flat. So I encourage people to try it out, but you could probably do okay with just going to listing sites. If you're under like 5 units, I'd say.
Good stuff. All right, so Mark, you have all this data at hand. You're local here in the Chicagoland area. What's your outlook on the Chicago real estate market over the next, call it, 3 to 5 years? Are you bullish, bearish, stable? What's your take?
I'm still living in the area, right? Obviously, I see potential. I think just like happens a lot in the national media, they cover Chicago in such a way they're like, oh my God, Chicago's a battlefield. If you go there, you're definitely gonna be killed. You walk outside. Everyone has this fear from like other areas. They're like, oh, Chicago's crazy. There are very good areas in Chicago. Chicago's a big city with a lot of different submarkets, and you can find some really promising areas. Like Pilsen is still developing like crazy. I think there's still opportunity to find really good deals there. And there are markets like, I was looking at Logan Square back when I was doing real estate analysis. I don't know how it's looking today, but there were still submarkets where like, yeah, if you buy here in 5, 10 years, you're going to be in a really, really good spot. So I think it's just getting granular and picking your markets well and kind of understanding where the opportunity is. I think there's a lot of opportunity across the board in Chicago.
Love to hear it. Mark, you good to wrap?
Good to wrap, man.
Let's do it.
All right. Mark, what is your competitive advantage? How have you been able to do this startup, new startup, dive deep into an area that has growth potential? How have you been able to do it when others wish they could?
At this point, it's experience. We've been doing it for 8 years. Same team stuck together, so we know how to dig into the details. We know what real estate people are looking for, and we come from real estate, which is the big differentiator. All these startups coming in from other industries, they don't understand like what the terms mean in real estate, and we do. So we're able to crush it.
All right, Mark kind of alluded to this already, but what is one piece of advice you would tell someone that is yet to buy their first property here in the Chicagoland area?
Read like crazy. Anything you could get your hands on. It's not just real estate related things, but read about business and technology and startups and of course real estate. Learn as much as you can because then you're gonna be better at analyzing trends, like broader market trends, and you'll be better at spotting opportunity. If you just go with what you know, well, you're going to miss out on a lot. I'd recommend read as much as you possibly can. That's just general advice, but I think it's helpful in this context too.
What do you do for fun, Mark?
I run, I read, and I hang out with my now 4 children. So my hands are pretty full. I wouldn't say I have that much free time outside of work and family, but when I do, it's running, bike riding. I do like to listen to audiobooks when I run. That's probably the best time to absorb info and get some fitness in.
Good segue.
Yeah, there you go. So, what is a good book, podcast, or self-development activity you'd recommend to our listeners?
I always recommend read The Lean Startup. That's kind of my startup Bible, right? Like you have to understand that before you want to venture into the startup world. Understand how it works. Read Steve Blank's books too, 4 Steps to the Epiphany, because he was the precursor to the Lean Startup. But then, just get your hands on like I recommend as far as like newsletters, TLDR in tech. Like not everyone's gonna dig in on tech as much as I do. It's not their job, but you should stay up to speed on what's going on. TLDR is a great resource. It's a newsletter It just tells you like 5-minute summary. This happened, this happened, this happened. These are impactful things in tech that, it could be your competitive advantage. If you find out about like some improvement in Chat GPT or some new tech before anyone else does, that could be the thing that pushes you to get the deal first.
Love it. Lots of good resources there. Besides yourself, name one person in your local network you'd highly recommend to other investors as a quality resource.
Sabrina, she set this thing up. I think she's phenomenal. Sabrina Watching, she's best PR person I have met in the real estate space and the tech space. All these other PR groups I've worked with in the past are like charge you a ton and don't deliver much. Sabrina charges you a fair price and delivers exceptional quality work. So highly recommend checking her out.
Yeah, so we give an award to people who've been on the podcast 5 times. I think at some point we got to give Sabrina something because I think she's referred like we're over 5. She hasn't been on, but
Yeah.
she's referred a
Well,
ton of people here. So yeah, she's been awesome. So Mark, thank you so much. You've provided a ton of value to our listeners. How can they learn more about you? Is there any way they can provide value to you?
So go to hellodata.ai, all one word, hellodata.ai, and just check it out. And if you want to schedule a demo, just click the schedule demo button. If you want to try it out, there's a 7-day free trial. When you click that schedule demo button, it will be me, right? Because we're a small team. We're pretty capital efficient here. So we'd love to talk with the listeners and show them what the platform can do.
I'm going to steal the term capital efficient. Someone says my team is too small. No, we are capital efficient. I like it. So, all right, we got a Chicago fact. Who are we playing for? Who's
All right,
sponsoring?
we're playing for this person that won. I pulled her name out of the hat for reviews. She left a review on iTunes. Mel Hereford. I think you sold them a few flat.
Was it Ellen? You said sorry.
Mel. I think Mel is that. It says Mel Hereford. Is that not maybe
Close
somebody
enough.
different? All right, all right. But Mel, we're playing for you. Brought to you by Straight Up Chicago Brokerage Team. If myself or Mark get this question right, then you get a $50 gift card brought to you by Straight Up Chicago Brokerage Team.
All right, so very good. So besides having 4 kids, I also learned Mark is an Illini grad. So
I saw
I
that. I
think,
thought that's why he was on here at first.
yeah. So I think me, him, and Workman are the 3 people I know now with those 2 things in common. So, and I believe you were from the University of Illinois School of Architecture. So
Yep.
I'm gonna list 4 statements. One of these is true. You're gonna have to tell me which one is the true statement.
All
All
right.
right, so you guys both get a shot at it. So, University of Illinois School of Architecture. A was the first public school of architecture in the U.S. B, home of the architect who designed and oversaw the construction of the Sears Tower. C, the largest architectural school in the U.S. with over 5,000 undergrads. Or D, it's where I started my journey at U of I, and it was my first major.
Which one's false or which one's true?
Which one's true? Only one of those is true.
Oh man, I should have looked this up before, but I'm gonna go with that's where you started too.
All right, Mark, what are you going with?
I'll go
Mark
with
Ainley?
Mark with a K. I'll go with the Sears Tower one.
Nah, so Mark Ainley knows me well enough to know I'm not smart enough to get in the architectural school, so I threw you for a loop there.
It was just too obviously and funny. Like I guess that was it.
It is the first public school of architecture in the U.S.
Really?
Oh, geez. I should have known that, but it was
Really?
probably go at this point.
Oh man, I appreciate D though. That was cool. I wasn't 100% sure. I had to think about our history.
We'll drop off some shirts and some swag for the Herefords over in Logan Square.
Yeah, there we go.
So-
Yep. Dang, I hate ending on that note, but all right, I'm gonna have to go.
I know,
look
great
that up.
episode. Then when you guys don't get it right, but if you get it right every time, it kind of sucks.
I know. All right,
If I give you layups.
Yeah, there you go. All right, well, Mark, thanks for coming on. Tom, thanks as always. Listeners, go to straightupchicagoinvestor.com and build your team. Maybe when this comes out, we'll have the new website format out. If not, we'll do a little launch as that coming up as well too. We're redoing the whole website for a better user experience. But check out straightupchicagoinvestor.com and specifically check out Build Your Team for various people you might need to fill in on your team for your real estate success here in Chicago. These are all people that Tom and myself have used and are part of our team currently. So check them out, straightupchicagoinvestor.com. Mark with a C, thank you very much. Tom, thank you as always. Listeners, we'll see you next week.
Thanks all.